Sometimes the biggest mistakes we make in life are when we fail to remember the basics. Take Silicon Valley Bank, for instance. What happened here? An editorial for the Wall Street Journal wrote this. One surprise for investors in the Silicon Valley Bank failure is that it didn't hold exotic derivatives, structured debt products, or other horrors that caused so much financial carnage 15 years ago. Far from it. SVB held boring treasuries and highly rated mortgage-backed securities in large quantities. How could these supposedly safe assets go wrong? End quote. So what's the answer to that question? Interest rate risk. That's what went wrong. Most of us are familiar with stock market risk, but this last year has been a lesson in interest rate risk. And that's been one of the failures of the bank. They failed to diversify. I think they did this in a couple ways. Number one, they had the same client base. They appealed to tech startups. So you have one client base bringing a bunch of money to a bank. When things are hot, it works great. And in that case, tech startups are doing well. Low interest rate environment, they bring a lot of money into the banking sector. And so this bank has one client. What's the problem with that? The problem with that is when that one client experiences a big downtrend, they might want their money back. And when they want their money back, if it accelerates through social networking and everything else, all of a sudden you have a bank run, which leads us to the second problem. The second problem with this is, what did the bank do when the money came in? Well, they invested, like the Wall Street Journal said, into safe securities, bonds. Treasury bonds, mortgage-backed securities, what are sometimes considered some of the safest of the safe investments, and they put it in there. But here's the problem. They do it in a low interest rate environment. What happened the last couple of years? What happened especially last year? All of a sudden, rates start to rise. The Feds raised rates high. So now the bank is sitting on investments that are supposed to be safe that are underwater. How are they underwater? Here's what happens. You purchase a bond a few years ago at a very low interest rate. Now, interest rates are up. So now what used to be, let's say, a 2% interest rate, now the bond issues at a 4% interest rate. So what happens to these old bonds sitting on your portfolio? They are underwater. They are lower. Of course they are. If I say, hey, I want to buy a treasury bond, I would like the 4% bond and not the 2% bond. So the bank has these investments sitting on their portfolio. The tech startups need money. They come to grab the money. All of a sudden, reserves are getting low. They may need to sell the investments. And now they got to sell at a way lower rate. And so that's some of what happened here. You had a failure of diversification on the investment side of the bank, and also a failure of diversification just on its Silicon Valley Bank, its tech startups. So again, life lesson. For all of us, sometimes we fail to remember the basics. Think about it. How do you have a good relationship? You might communicate. Communication is essential to every kind of relationship. How will you be good with finances? One basic would be, don't spend money you don't have. What happens when you break some of the basic rules of life? You end up having problems in those areas. And here I think is another thing. Sometimes we get fancy. We get successful. We start making more money. We start thinking in higher strategies and complexities, and we forget the basics. So let this be a lesson. Remember the basics. Human nature does this all the time. What's that quote about insanity is repeating the same thing over and over again? In the financial world, this happens over and over again. The same story, different names, the same story. So for you, let's remember this. Let's diversify. Let's go back, remember the basics of financial habits. And let's also not get so caught up on the news, on having our minds melded into the news all the time, because some of this is the same thing. Is it hard? Do people lose money? Can it be challenging for our investment portfolios? Of course. But again, what do we need to do? Remember the basics.